and potential outcomes for interest rates as a result of all of this stuff that's going on. Just a quick timeline of the tariffs. Unemployment is rising in Canada. I would expect it to continue. National home sales are now back below the 10-year monthly moving average. How the economy responds to changes in interest rates. This is going to be a problem that will affect pretty much everywhere in Canada. I don't know if anybody will necessarily be safe per se. It's probably the most important piece to be watching. This is a key talking point to customers right now. But basically, RBC is forecasting that we'll see interest rate cuts. My name is Daniel Foch. I'm a real estate broker as well, I guess by trade, although um, I've kind of ended up more in like a lead gen role. And at my current brokerage, I'm chief real estate officer. We're sort of like a tech platform, and so I basically just make content and do research to advise people and real estate professionals on the trends that are happening in hopes that that'll help them better advise their clients. And that's really what this whole call is all about. I do this something similar for the GTA with my brokerage for agents in the GTA who are trying to get an understanding for what's going on, how all of these different economic trends are impacting people. And the reason that I have gotten so good at this research is I host Canada's #1 real estate podcast, and so it's my job in that capacity to basically stay on top of all of these things. And Jordan and I have collaborated a lot on that. We use a lot of REM articles on the show. And similarly, we post a lot of podcast content on REM. I think that's kind of a summary of what I do. I guess the last piece is that I built the data science platform for the Toronto Real Estate Board called the Habitat. It should be available to other real estate boards moving forward. And we also have a CREA version. It's not working exceptionally well today, so otherwise I would have used it on the call. But for next month's call, I'll make sure to have that available so we can actually check some real-time data and kind of like do some charts if people are interested. Yeah.
Super. I will let you take it away. If anybody has any questions, feel free to pop them in the chat at any time, and I'll play them to Daniel.
Sure.
Otherwise, the floor is yours.
I appreciate it. Yeah, as mentioned, if anybody has questions, like feel free to just put them in the chat, and Jordana can kind of just prompt me to respond to them. I'm typically prefer for this to be a discussion rather than a presentation. So if you want to interrupt me or if there's anything you want to talk about a little bit more specifically, I'm happy to do that. Just going to share my screen here.
Yeah, and we've got this in the book for an hour, but I think it'll take 30 minutes at best.
Yeah.
So
But yeah, about 30 minutes. And then typically like I like to do a Q&A and afterwards, and that usually can be 15 minutes to a half hour. So yeah. Okay, so the four things I'm going to talk about today are the big one being tariffs. I'm sure all of those of you who are real estate professionals, you've been hearing a lot about this from your clients. It's kind of one of those headwinds. I find that Canadians really pause their purchase decisions whenever something major is happening in the economy or politics in Canada or the US, obviously, because we're so impacted by the US. I'm going to talk about employment, and then I'm going to talk about the housing market, obviously, and potential outcomes for interest rates as a result of all of this stuff that's going on. So this is an article from yesterday. It says that Trump says that Canada and Mexico tariffs are going forward with more import taxes to come. So just a quick timeline of the tariffs. There were going to be blanket tariffs on everyone, including Canada and Mexico, or there were going to be 25% broad-based tariffs on Canada and Mexico. And then there were some criteria that we had to hit. They were both put on pause with some changes made to Canada's policing of the border and money laundering and fentanyl issues. It seems like that's now been walked back as well. There was a point where it was just on steel and aluminum around the world, and now it's looking like there was a threat of auto tariffs coming in April, which I'll mention a little bit here. And now it seems like we're kind of back to the original iteration of tariffs. And so this is one of those things. This is one of those kind of those question marks that Canadian home buyers tend to have a pause and reflect moment. I think we saw that in November when Trump was elected, where it's just too much uncertainty for Canadians to say, yeah, I'm gonna. It's not that they're not gonna make the purchase decision, but they're they develop a little bit of a reluctance to make that decision as a result of some of these things, and they start putting more thought into it when there's uncertainty ahead. As a result of this, national home sales are now back below the 10-year monthly moving average, according to the Canadian Real Estate Association's data. And so that black line you see is the 10-year monthly moving average. We spent a long time below it, and I'll kind of explain why that is in the next slide. But we started that recovery period that you often see, like usually whenever you see us spend a significant period of time below the monthly moving average, uh, once you've achieved your recovery, it's pretty rare to break back down below. The reason I would say that we're below that on, and again, this is the number of sales, it's not house prices, it's just how many transactions are taking place. And the big reason that we're seeing that is because, from my perspective, there's so much uncertainty that Canadians are not confident moving forward with a significant purchase decision immediately. And so the momentum that we saw in October and November kind of got erased from the election. And then I think the typical spring market momentum that you would see rebuilding um, seems to have been uh, put on pause until we have some sort of firm resolution on what this tariff situation looks like. And the Bank of Canada has really been observant of this. Tiff Macklem recently put out a presser about tariffs and what would have to happen. We'll talk about that a little bit in the interest rate segment, but I mean, this really would be, during the pandemic, he mentioned that, we saw a really steep drop in the economy, and then it kind of bounces back pretty quickly. That there would be no bounce back in the situation of tariffs, because it has a lasting impact on Canada's market. Um, this chart I'll be referencing throughout the presentation, but this is one of my favorite charts in such that it really shows how the economy responds to changes in interest rates. This is from an economist named Michael Cantro on Twitter. Um, and so the first place that we see the housing market, or sorry, the first place that we see the economy slow from interest rates is through housing. And the reason for this is because housing is the most debt dependent market. So um, people buy houses with credit, and so as soon as the pricing of credit goes up, then the buying power of them buying a house goes down, or um, the process of them buying that home slows. And so we saw both of those things take place as soon as the rate hiking cycle started in Canada in Q2 of 2022. Some markets, some more affordable markets, saw it slower. Some markets didn't see it at all. Your Calgarys, et cetera, where those markets were more affordable, and they were actually taking, people who were um, leaving less affordable markets like BC and Ontario, were going into maybe more affordable markets like Halifax or Calgary. Um, but for the most part, and if you look at the national average, and maybe not just the prices, but the number of transactions, we did see a decrease. You can see it here actually, like, you're basically, as soon as the rate hiking cycle started, um, you you basically, your transactions fell below the 10-year average, and it stayed there until the rate cutting cycle started. The next thing is new orders, right? So new orders refers to basically you buying stuff, you ordering new things from businesses. And new orders would slow because if you're not buying a house, maybe you're not buying a deck to upgrade your house, or maybe if you're not buying or selling a house, you're maybe not renovating your house to sell it. And so Home Depot starts seeing a decrease. This is just the easiest example for me to use for a real estate audience. Home Depot starts seeing a decrease in um, transaction volume and people buying materials to renovate their homes, as an example. um, when they start seeing that top line revenue decrease, their profit starts to suffer, right? And so when a business's profit starts to suffer, what do? They typically will lay people off, right? And this is where we're at now, which is we're at that kind of the E, which is employment, the most lagging part of the economy. And this is where we're really seeing significant changes in Canada's economy right now, and it's probably the most important piece to be watching. On the flip side, the benefit is, now we're at the bottom. as rate cuts start, what starts to resurrect the most quickly, or what starts to speed up the most quickly, is housing, right? As rates come down, then people have more buying power, and so housing got hit first, and we were in a recession. I mean, real estate professionals have been in a recession for 2 years since the rate hiking cycle started. And now that we're in the rate cutting cycle, everybody else is just getting to that recessionary period because it takes them a lot longer to see that decrease in profit and decrease in employment. And then people start getting layoffs and we start to see consumption in the economy decrease. Now, because interest rates are coming down, the people who still do have, gainful and predictable employment and who aren't concerned about the profits of their businesses or new orders are buying houses, right? Because they have more buying power and it's more affordable. And so you start to see the economy recover in the same way. Housing comes first and then new orders, people are buying houses again. Home Depot is selling more decks and flooring and stuff like that. Their profit starts to rise and then they start rehiring a lot of those people. And so typically, market bottoms will correspond with these housing bottoms that we see. This is one of the things that we haven't really seen. This is US data, so it's a little bit different, but we haven't necessarily seen the remainder of the economy, although it seems like it's kind of starting to get a little bit shaky in the equities market today. We haven't really seen the remainder of the economy drop to reflect what's happening in the housing market. Um, I think one of the big factors here around that is, the US market might have been able to actually kind of just like chug along based on whatever's going on down there with retail capital really pushing up the stock market. But I think that Trump's tariff program has really taken the steam out of the US economy. And since we've seen the change, like right now, the only tariffs that we're actually faced with are steel and aluminum. And to be honest, it almost does feel like these are tariffs that are targeted at Canada because Canada stands to be the most affected by these steel and aluminum tariffs. So even though they kind of rolled back the broad-based tariffs that we're going to see from Canada, they instituted these ones, which are likely to impact us even more. And I'll go through a city by city breakdown of which markets are going to be most impacted by broad-based tariffs, but also by the steel and aluminum tariffs. The steel and aluminum is kind of easy. You have Steel City in Canada and Aluminum Valley. Steel City being Hamilton and Aluminum Valley being the Saguenay area of Quebec. The trade balance is not as, I guess it doesn't leave us as exposed as we were in like a 2022, but we still are, kind of one of the biggest times that we've been consuming US aluminum and steel. And again, you can look back at 2019 and 2020 as examples of Trump era years, because half of 2020, well, I guess 2020 was his final year, 2019. And if you even look back at 16 and 17, what ended up happening was there were tariffs, right? We've been through this before. We know what this looks like economically. The way that it impacts businesses, you could see, Canada went through a little bit of a recession. The US went through a little bit of a recession. Rates came down. What ultimately ended up happening was the US government had to start allowing exemptions for Canadian businesses and there was something like 70,000 exemptions by the time. And it sounds like Trump doesn't want to allow that to happen this time. But my perspective is he likely won't be given a choice. He's already got automakers really pushing him. He's already got a lot of other businesses. And I think Trump will probably be faced with the question of whether or not he wants to preside over an economy or whether or not he wants to be known for having a good economy and stock market or being America first. And I'm interested to see the outcome of that decision. But I think I know the answer, and it would be the former, that he probably will want to try and keep the stock market and the economy strong. On the bright side, so like steel and aluminum isn't really an easy supply chain to just create. So if you look at the 1819 steel tariffs, the US steel and aluminum output capacity was actually higher before that tariff program, and it's been decreasing ever since then. And so they do have a pretty high degree of dependency on Canada for those. The other piece is the auto tariffs. So we have basically potential for the automakers. There's a handful of cars that are made in Canada, but your cities that are especially exposed would be Your Oakville, Oshawa, Ingersoll, Holliston, well, basically a lot of Ontario, to be honest with you. There's a handful of markets in Ontario that would be exposed should we see auto tariffs. Automakers are really upset about this, by the way. Like there's a lot of public outcry from automakers about how this would be a huge issue, and they're making an effort to kind of have Trump walk back his attempts to put auto tariffs on Canadian and Mexican vehicles. The biggest reason being, well, like there's a couple of different ways to think about this. So if an automaker wants to move a line down to the US, it would take them like 2 to 4 years. And so a lot of them are thinking, oh, we can just wait this out, right? Yeah, we'll make the consumer absorb the higher cost, and that's going to suck, but it's cheaper than us trying to actually move to the US. And then the next one is, that even if they did move it, it would increase the cost of the vehicles delivered to the consumer substantially. They're estimating about 6% minimum because labor costs in the US are so high. Um, so it will be interesting to see what happens in this regard. Just a quick little overview on the imports from Canada to the US, or sorry, things that the US imports from Canada. Oil and gas is the biggest one, which is only subject to a 10% tariff right now. Transportation equipment, which is your auto like vehicles, is the next one. And then primary metals for manufacturing, so that's your steel and aluminum, which was the other tariff that we have on the go.
Daniel Robert just has a question. He wonders if a new Canada-US auto tax might uh, be the outcome.
I would hope so. I think it would be a good outcome, and maybe that's really why Trump is doing these things. I think there are a lot of things that need to be rethought from our trading perspective for the benefit of both Canada. I mean, oil and gas is another good example of places where Canada probably isn't necessarily winning. And as soon as you start these discussions, whether or not Trump thinks that he's going to win with the outcome of the discussions, as soon as you start them, there is a way for Canada to get some things from the levers that are in that negotiation, we'll call it. Um, I think that would be it would likely help. I don't know whether or not it's a likely outcome, but it would be a good outcome. Um, so now we're gonna kind of try and I just had to really try and set the stage a little bit, and now we'll try and bring it back down to all of the different real estate markets across the country. So Canadian Chamber of Commerce and Oxford Economics both did analysis on basically what cities in Canada are most exposed to Trump's tariffs. The top three across both studies were St. John, Calgary, and Windsor. Um, and I'll get to why in a second, but basically everybody who's to the right of this dotted line, which is the Canadian average here, would be more exposed. There would be places that you might want to worry about. Um, and you can kind of see as you go up here, that's how much you're trading to the US. St. John actually being 140% because they refine, so over 100% because they refine oil from outside of Canada, and then trade it to the US. So it's over 100% because it's not just Canadian goods. So St. John would have 131% tariff exposure index, the highest by a long shot. And again, this is because it's the nation's largest oil refinery. The Irving Oil Refinery is located in St. John. If you're a realtor in any of these markets, I would really like to me this is a key talking point to customers right now. Everybody that I'm speaking with and all the agents at my brokerage are dealing with concerns about tariffs and the outcome for the economy. And so it's looking at your city, where it falls. What are the key jobs? What's the likelihood of layoffs in that industry? Do we think that this is going to be a market where, the economy is going to hold strong, or it's going to suffer? Maybe we'll see some supply, some people selling to try and, take their home equity out to have a little bit of padding for the next couple of years, and maybe a little rent and buy back in when things are looking a little bit more economically normal. Again, like I think that the really ugly part about this is that Trump has basically made it clear that he wants to do this as like almost an economic warfare, and that is going to have consequences. And I think that that's probably the automaker piece of the puzzle is that he knows that Ontario is sort of the heart of the Canadian economy. And if you wanted to take Canada down per se, which it seems like for better or worse, that's sort of where he's leaning. Um, that's kind of the direction you would go. So your top ranked companies from an exposure perspective, like negative exposure, would be St. John, Calgary, Windsor, obviously big auto parts manufacturing trading with Detroit, Kitchener, Waterloo, Cambridge, a big manufacturing base there, as well as Brantford and Guelph. And then 7 and 8 here are your Saguenay and Hamilton, which is your aluminum in Saguenay and your steel in Hamilton. Um, I guess maybe also worth looking at kind of your what cities are least exposed, and a lot of them tend to be. I never thought I would say this, but bureaucracy is actually sort of a stability factor here. Halifax has a ton of jobs from the military, as well as deep water ports. You've got Regina, which is very much a government city. Sudbury is interesting because it is a lot of the mining and stuff, but you have such a diversity of different minerals around Sudbury, as well as again some government jobs and healthcare jobs that have built in a little bit of protection for that market. Again, if you're looking at your own city, or if you want to do this on maybe a more province by province basis, another good way to look at it is how much of it are we doing based on different or sort of the structure of the sector in that economy. And so you see like St. John's and Calgary as an example, where the majority of this is from extraction and then a small portion from manufacturing. Seems to be a big portion of why that exposure is the way that it is. Canadian Chamber of Commerce laid this out on a map as well, but actually probably a better map from Oxford here. Again, as you can see, you've got your three red markets here. Calgary being the highest, the largest market, but not the city that is the most exposed. But you can also see like this whole 401 corridor has a massive exposure. So again, this is likely going to be one of those things that um, it could. This is going to be a problem that will affect pretty much everywhere in Canada. I don't know if anybody will necessarily be safe per se. If you look at it on a provincial basis, Alberta and New Brunswick are the two most exposed, mostly because of the oil industry. Even with a 10% tariff, the U.S. appears to be wanting to fulfill a lot of its oil demand from domestic production. Will it be able to do that? Probably not. Is it going to piss off a lot of U.S. consumers that they're instantly paying 10% more for oil? I don't know. It happened in Canada, and people didn't really seem that upset about it over the last 24 months, to be honest with you, because of the carbon tax. So I actually think that consumers are going to be less uh, upset about something like that because oil price, like gas, like your fuel that you're filling up your vehicle or running your business off of, is so volatile. A 10% increase is like something that would be, yeah, it's visible, but um, it's not something that is really gonna upset people. I think what is going to upset them is when they go to buy a new car and it's 25% more or 20% more, or when they're going to buy consumer goods and they can actually notice the price, that they'll start to really. That's when you'll start to get, I think, a little bit of social pushback for these policies, and I do think that we'll start to see them get unwound as the economy is suffering as a result, and it won't really be producing positive results for the U.S. economy as Trump hopes. Um, a- and so my guess is that this is probably only a year or two that we have to deal with this, but I think it's still something we have to deal with. Um, I probably won't. I guess actually, yeah. I'm just trying to look at the time here. Yeah, so I'll quickly go through. I mean, basically, just the supply chain in North America. The U.S. depends a ton on Canada and Mexico for trade. There's a lot of goods crossing the border like multiple times. So, like as an example, build a mirror for a car and it goes across to the U.S. and then it gets something else, and then it comes back to Canada and it goes back and blah blah blah. And so there's so many things that broad-based tariffs just won't be able um, and this is a chart from RBC that shows that our supply chains are too integrated to withstand tariffs. I think that our supply chains are too integrated to tolerate tariffs. Like I just think that you'll note a lot of these proposals won't survive. Um, I mentioned on the city by city analysis that you want to kind of see like what type of impact this could have on employment in your different markets. And we do know that Canada's unemployment rate is rising. It did seem to pause in December, which is why I use November data, because I actually am not super confident that StatCan is looking at the non-permanent resident outflows properly. And I'll get to that a little bit as well. But unemployment is rising in Canada. I would expect it to continue to rise. If you look back at like 08, 09, I think we hit about 8 to 9%. I think that we'll probably see as bad of a unemployment scenario as that period of time, if not worse. I would probably be looking more for the 1990s as a comparison. So maybe like just over, over 10%, maybe between 10 and 11%. And I just think that economically the setup is very similar. We saw house prices peak in 89, immigration or population growth peak in 89. We just saw the same thing happen here in 2022. Um, the unemployment rate isn't rising due to layoffs yet substantially. It's really actually mostly because people are having a hard time finding jobs for now. Again, I think we are starting to see those layoffs, but it hasn't been the major driving factor. And actually, if you look back, sorry, just these huge jumps up where you see red being large, that's from basically entry from outside of our labor force of people joining the Canadian market. Now we're seeing that basically being a net negative factor. So we're not seeing a huge increase in population growth. We're actually seeing a decrease in population growth, and if not negative population growth potentially from non-permanent residents leaving. And so again, based on what I was saying with the StatCan data, as people are leaving Canada, that's people leaving the labor force as well. Job vacancies, one of the ways to kind of read how this is impacting the real or flowing through from the real estate perspective, and downstream of it is construction job vacancies. And construction job vacancies haven't really deviated from your total job vacancies. So I'm not seeing as much of a concern as I thought I would before. And a lot of that is because you're seeing a massive amount of proposed residential development and commercial development. I meant to exclude these because they're Toronto specific, but CMHC has basically at a national level, you've got growth in construction and housing starts basically over the last little while, like last several decades, and they're expecting that to kind of taper off over the next 3 years, simply because interest rates are higher, demand is a little bit lower. We've already built a ton, and so that kind of housing shortage question is being proposed again. Is are we actually dealing with that issue? CMHC illustrated how the economy is facing a couple of different potential scenarios based on the uncertainty that we're facing. I would say that probably somewhere between the low to medium scenarios, what I'm forecasting for, I think your low is kind of severe, and your medium is probably a bit optimistic. RBC here observed that we are seeing inventory of homes rebuilding in Canada, and we're like for those of you who have been in the industry for a while, we're sort of in a market that's more comparable to your like '05 kind of pre GFC. So like again like your '05 market, but not in those like higher inventory markets like we saw in 2010 to 2015. And then obviously we all know what happened during COVID when we basically were dealing with inventory shortage. Um, we're kind of back from that, and back at a point where we're not yet in a technical buyer's market, but I think we're sort of in a market that seems to be behaving that way in many parts of the country. Um, Population growth being a big piece of the puzzle, obviously. This is one of the interesting ones. I mean, a lot of people always talk about how Toronto gets most of the population growth, and it does on a volume basis, like just on a pure number, because it's the biggest city. But you don't notice. you don't notice it as much because the city's already big. And so from a magnitude perspective or percentage change perspective, Calgary and Edmonton really stand on their own in a perspective of how much population growth they've seen. And it's not just over the recent little bit, like this has been basically since 2001. If you use 2001 as your baseline, Calgary up almost 70%, Edmonton up almost 60%, whereas like your Torontos of the world are up only 30% in the last 25 years. Um, I think this is a trend that we will likely see continue, provided that Alberta is able to continue to provide housing at an affordable rate and provide jobs that pay well. The biggest challenge that most Canadian cities are seeing, Vancouver and Toronto being probably the worst culprits, is that you can't make a lot of money and it's very expensive to live there. And so they've really become disparate areas, right? Where you've got a lot of wealthy people, but your median or average wage is really low, especially relative to your median average house prices. Um, Back to RBC's analysis on housing affordability, and interesting in regards to what I mentioned about Toronto and Vancouver is interest rates really can only do so much work to get housing to be more affordable. So if you look at ownership costs as a percentage of household income, Canada. So every time you kind of go through one of these cycles, you see like this double peak. So the 1990s, you saw this double peak. We see it here as well. So the first peak is your house prices getting out of control and the central bank basically cutting interest rates to improve affordability. And then the second one is from the second drop is from that actual rate. Sorry, I got it backwards. First peak is from the house prices getting too high and the central bank increasing interest rates to stifle your demand, and so you'll see demand kind of get pinched a little bit, and that's where you come over your first peak. But then as prices stabilize again and affordability sort of continues, and now you're at these higher rates, and that's where that second peak comes from. And the drop after that comes from rates getting cut. Interest rates really can only cut or add so much more affordability to the market. Basically, if we cut another 75 basis points, we're at the B20 stress test rate based on your fixed rates right now. So after you hit 5.25% qualifying rate based on the stress test, you can't really add more buying power to people after that because everybody will just be stress tested. Everybody will be qualifying at 5.25%. And we're about 75 basis points on the fixed rate from that right now, about 100 basis points on the variable rate. And so in order for housing to become more affordable, what we need is we need incomes to rise or we need house prices to come down. House prices coming down, it feels less and less likely, to be honest. I think that the market seems to have been stabilized. I think tariffs could be the one big thing that could really blow a hole in the side of the whole thing. And that's kind of the X factor that we should be watching for. But um, rising incomes is really the one that the economy and central bankers and the government would want to be relying on to help make housing more affordable. Whether or not we can do that with a rising unemployment is is kind of the big question. I think it's easy for house prices to come down at a national level based on like average data being skewed by like the GTA as an example. If really if we just see a little bit more correction in the Ontario market. Um, as mentioned earlier on, like kind of real estate being in a recession, will likely be the first ones to kind of come out of a recession while everyone else is just going into one, because as interest rates ease further, home sales activity typically picks up. People can afford to buy houses again; they will buy houses again. Anything else in the chat here that I need to? I
Got
think
some
we're good.
questions and comments for you, but we can.
Yeah, maybe I'll just do them at the end. Yeah, I'm almost done here. RBC does expect house prices to post a little bit of a gain this year, about 1.4%. It's worth noting that we're running at about a 2% unemployment right now, or sorry, 2% inflation right now. And so on a real house price basis, you actually would be so adjusted for inflation, your house prices actually aren't going up. So really just inflation is what's pushing them up right now. Um, Quick overview from Canadian Real Estate Association stats. So, new listings, the highest level we've seen since the beginning of the pandemic. Home sales not down a ton, down a little bit, but sort of in line with what we've seen over the last little bit. Now, again, relative to listings, it's probably a little bit alarming. If we don't see them recover and we start to see inventory continue to pile up, yeah, we could probably end up in a buyer's market within the next couple of quarters. But home sales are basically where they were at the beginning of the pandemic, and this is before the big drop. So probably a normal market. Question is, will we see a normal supply market, or is unemployment and economic fear going to push more people to sell? Months of inventory and sales to new listings ratio, pretty much in line with what I would call probably a normal market, the same market we've seen over the last little bit, but it has come down quite a bit on the sales to new listings ratio after seeing a pretty strong bounce back in I wouldn't even say Q4 of last year, but basically October and November were really strong last year, and then December, kind of post-Trump election, a lot of the talk about the things that he was going to do in January, really Canadians kind of hit the pause button, and we tend to do that. Prices have been basically flat since the drop, up a little bit, I guess, off the bottom, but basically, and this is very very much similar to what happened in the '90s. You saw a big drop, and then basically a sideways market for 4 or 5 years. A little bit of a grind down on prices after that. I already covered this one, but basically sales are back to the 10-year average. A little bit on population growth. Provinces are going to be less impacted by the policy changes, where basically we're seeing the Canadian government getting non-permanent residents to leave. Um, Saskatchewan, Alberta, and Manitoba saw the least percentage of total population growth from non-permanent residents. Ontario and BC significantly exposed here. Ontario facing the biggest prospect of non-permanent resident outflows. Um, as a result, because they didn't see that same unprecedented population growth that Ontario and BC did, the prairies have basically been able to achieve relative affordability. And again, I think if they can continue to do that, Calgary kind of being the outlier here, but still far better than historic affordability. But if they can continue to do that, I would say that the prairies probably will really be just the stable markets in Canada for the next like 5 to 10 years. Rent growth is a big one. We're hearing a lot about rents coming down pretty much everywhere. I would expect that rent growth is definitely going to slow. It should fall in line. This comes from CMHC, by the way, their rental market survey. There's a couple of outlier data points here, these darker data points, whereas typically you see the historical relationship between rents and vacancy rates. You've got some markets, I would say this 5% vacancy rate might be Calgary, where you see a 10% rent growth year over year. That should be a lot lower, and typically it just takes a year to kind of get back to normal levels. Um, I mentioned, like how RBC saw house prices kind of coming up, 1.5%, let's say, and inflation's at 2%. And one of the things I really want to look at is, like, we hear all about how Canada's house prices are so detached from reality compared to everywhere else, but a lot of it really is because we ran such a hot inflation scenario compared to other countries. Um, so the US market is basically still above their 2020, so pre-COVID levels. Um, Canada's real estate market is actually below pre-COVID based on house prices adjusted for inflation. And so, what I expect will be the outcome, especially with tariffs, because tariffs can be inflationary if we see Trudeau kind of pushing back with the trade war, or Carney pushing back with the trade war, or whoever it is, even Pierre post-election pushing back with the trade war. If that ends up being the case, that'll end up being inflationary for the Canadian consumer. It'll be bad. It'll kind of take growth out of Canadian GDP, which would be deflationary on or disinflationary on GDP, but on prices, Canadians will end up paying more. And so if we're in a higher inflation environment, even if house prices are growing, if inflation is higher than house price growth, then you're actually seeing all of the value that you're getting from your house going up in value being inflated away. Um, And this is kind of where it leaves the central banks in an interesting position. I think so. RBC is forecast basically, and I'll go to the page about all of the rest of the banks in a minute. But basically, RBC is forecasting that we'll see interest rate cuts, probably another 100 basis points of interest rate cuts. I think they actually forecasted 75 basis points. So right now, um, yeah, as it stands right now, basically the majority of the banks, except for Scotia, and this is not assuming tariffs, uh, is that they expect that the overnight rate to be between 2% and 2.5% by the end of this year. So basically, 50 to 100 basis points below where we are right now. I would say tariffs probably are only going to increase how much they expect that to get cut. So anyway, I'm happy to field any questions that anybody might have now, or Jordana, if you have anything you wanted to chat on.
I have a question. So I know you said
Yeah.
before that the Toronto data and Vancouver data can heavily skew national data. What impact are the influx of condo listings having, the increase in that we're seeing in listings across the board, I guess?
Yeah, I would guess that it has a pretty significant impact. CMHC, actually, I thought I put it in the deck, but I might not have. But CMHC had put a no, I didn't, because it was mostly Toronto focused. But yeah, basically like 50% of the growth in new listings in the GTA is condo supply, and so the market looks totally normal if you take out the fact that there's so many condos being listed. I think that that's probably, and I'll actually have to dive into it a little bit on the CREA data once we have the dashboard for next month. Maybe I'll try and do that. But it's it's a great question and a great observation that we're definitely seeing a lot of that new listing growth coming from condos for sure.
And this question came up, I think it was the employment numbers chart that you had, but in terms of seasonally adjusted data,
Yeah,
what are your thoughts on that?
yeah. Yeah, I mean, like, well, I think it might be more in regards to the CREA data. I mean, I'm not a fan of seasonal adjustments, but the reality is it's kind of the only data we can really get from CREA, and so I just use what I can, right? But I've heard a couple of economists make the joke, like seasonally adjusted, that I would be George Clooney, right? Um, it's really easy to make things look good, um, especially when you can kind of like ultimately always change the seasonal adjustments. What I'll do for the net for next month's deck is I'll put the seasonally adjusted HPI, like the house price one, where you can basically see like the big jump and then like a perfectly flat line almost, uh, and versus the line where I showed where it's not seasonally adjusted, where it's actually just the average house price, where it's bumpy, like where it's kind of just bouncing along the bottom. I mean, in the fullness of time, like it doesn't really matter, but on a month by month basis, it is hard to use those seasonally adjusted data points because they're not super reliable for real time. But to look back, it gives you a flatter line. So historically, I'd say they're somewhat valuable. In real time, they're not probably not valuable data points, but CREA only gives us basically they give seasonal adjusted data for everything except for price. And price, they give you HPI, which is seasonally adjusted, or the average price. So yeah, it's kind of one of those things where you just kind of take what you can get, right?
Interesting. I don't see any more questions or few comments, but Daniel, I want to thank you so much for putting this presentation together for us and
Yeah, my pleasure.
super informative. Would love your feedback. Thank you everybody for joining us. Let us know where you're from just before you jump off. So maybe next month we can
Yeah, that would be great if people can let us know where they're tuning in from. I'm from the GTA, by the way, but I'm actually in California right now. So
lucky you.
got London, Ontario, Calgary, GTA. Cool.
Awesome. Yeah,
Yeah,
really good information. I totally agree. We're gonna do it again next week. Not next week, sorry, next month. I think
next month. Yeah,
we landed on the last Tuesday of every month just to avoid any overlap with the CREA data being released.
for sure.
So, okay.
Okay.
Thanks, everybody.
Thanks so much.